Welcome to the Deep Dive. Today we're tackling a really complex topic, wading through quite a stack of IRS guidance, court rulings, and legal analysis. We're diving straight into U.S. federal tax law for virtual currency. Our goal here is simple. Cut through the jargon. We want to pull out the core principles you absolutely need to know, whether you're mining, trading, gifting, or just selling crypto. Basically, your essential guide to compliance.
And that clarity is, well, it's really needed. Because the assets are cutting edge, but the tax rules, they're often based on property principles that are decades, sometimes even centuries old. We're leaning heavily on the foundational guidance here that's mainly IRS Notice 2014-21 and the FAQs that followed. It's definitely a changing field, but the core tax philosophy has been surprisingly consistent so far. And just to be clear, we're only talking U.S. federal tax today.
Okay, let's unpack this then. And I think we have to start with the single most important classification, the one thing that shapes everything else.
Right.
If there's one thing you remember from this, make it this. For U.S. federal tax purposes, virtual currency is treated as property. It's not currency like the dollar or euro. And crucially, it's generally not treated like a security, like a stock or bond.
Exactly. That property label is the absolute linchpin. If it were treated as foreign currency, you'd be wrestling with completely different gain and loss rules. Thankfully, you don't. And if it were a security, well, a whole different set of potentially more restrictive rules would kick in immediately.
So property, like owning a house or maybe a piece of art, what does that actually mean for someone actively trading? Are there advantages compared to, say, trading stocks?
Oh, definitely. The biggest one, arguably, is the wash sale rule. You know, the rule under Section 1091 that stops stock traders claiming a loss if they buy back the same stock within 30 days.
Yeah, that catches a lot of people out.
Well, because crypto is generally property and not a security for this purpose, that wash sale rule simply does not apply to virtual currency trades.
Wow. Okay, that is actually huge. So you could sell crypto at a loss to offset gains and then, immediately buy it back if you still believe in it.
Precisely. It allows for what people call tax loss harvesting without that 30-day waiting period. It's a significant bit of flexibility that stock traders just don't have. You maintain your market position while managing your tax bill.
Okay, that's a big one. What else comes from it being property?
The other key thing is what happens if a token goes bust. If your crypto becomes genuinely worthless, zero value, completely abandoned, you can generally claim a loss deduction for worthless property under Section 165. This loss can potentially offset other income, which is different from certain worthless securities rules. It's another useful relief mechanism.
Right. So treating it like property gives some flexibility. Okay, so if it's property, how do we figure out the profit or loss when we actually sell it? It must come down to the basic formula, right?
It does. It follows the general tax principles for property disposition. Your gain or OSS is the amount realized minus your adjusted basis. Section 1001, basically.
Amount realized minus adjusted basis. Let's break that down. Amount realized sounds straightforward. It's what you get when you sell.
Mostly, yes. But in crypto, you might not just get dollars back. The amount realized is the total of any money you receive plus the fair market value, the FMV, of any other property or service you get in exchange. So if you trade, say, Bitcoin for Ethereum, your amount realized for the Bitcoin you sold is the FMV of the Ethereum you received at that exact moment, valued in US dollars.
Ah, okay. So even crypto-to-crypto trades trigger a taxable event based on the dollar value at the time of the trade. You have to value everything.
Everything has to be valued in USD at the time of the transaction. Now, the other side is the adjusted basis, essentially, your cost.
Right, your cost basis. If I buy Bitcoin with dollars, that seems simple enough. It's the dollars I paid plus any fees, right?
Exactly. Purchase price plus acquisition costs, like fees and commissions, that's your starting basis. But it gets more complicated depending on how you got the crypto. What if you didn't buy it with cash?
Like if you earned it.
Yes. If you receive virtual currency for providing goods or services, your basis in that crypto is its fair market value in USD on the day you received it as income.
Okay, so let's say I do some consulting work and get paid $5,000 worth of Solana today. That $5,000 is my income now, and it's also my cost basis for that Solana going forward.
Precisely. You report the $5,000 as income today, and that $5,000 becomes your starting point, your basis, for when you eventually sell or exchange that Solana. If you later sell it for $10,000, your gain is $5,000.
Got it. So you establish that USD value up front. Now, what actually triggers the tax event? What counts as the disposition?
A disposition is generally a sale, an exchange for other property, including other crypto, using it to pay for goods or services, or even things like confiscation or abandonment. Basically, anytime you relinquish control in a transaction.
Okay, but what about just moving crypto between my own wallets? Like from my exchange account to my personal hardware wallet. I do that all the time. Is that taxable?
No, thankfully. That's a really important clarification the IRS made. Transferring virtual currency from one wallet, account, or ADG that you own and control to another wallet, account, or address that you also own and control is a non-taxable event.
Whew. Okay. That's good to know. It's just like moving money between your own bank accounts.
Exactly. It's just a change in where you're storing it, no gain or loss is realized.
All right, that covers buying, earning, selling, and moving it around. But people get crypto in other ways too, right? What about things like mining?
Yes, mining. If you successfully mine virtual currency, the rules say the fair market value of the crypto you mined, calculated on the date you received it, is immediately included in your gross income.
Included in gross income, so it's taxed as ordinary income right away.
Correct. It's taxed as ordinary income in the year you receive it. And that FMV, the amount you included in income, then becomes your cost basis for that mined coin when you eventually sell it.
The IRS calls it an award in some guidance, which always struck me as a bit odd for mining.
It is a slightly strange term, yeah, because who's giving the award in a decentralized network? But terminology aside, the tax treatment is clear. FMV included in income upon receipt, and that FMV sets your basis.
Okay, what about forks and airdrops? Those happen quite a bit.
Right. Forks. We need to distinguish between soft forks and hard forks. A soft fork is just a protocol update that doesn't result in you getting any new crypto. So no income, nothing to report there.
Makes sense. No new asset, no income.
But a hard fork, if it's followed by an airdrop where you actually receive new cryptocurrency because of the fork, well, that's different.
So if I hold Bitcoin and suddenly get Bitcoin Cash because of a hard fork and airdrop, that is a taxable event.
Yes. The IRS guidance says you have ordinary taxable income equal to the fair market value of the new cryptocurrency at the time you gain what they call dominion and control over it.
And control, meaning when I can actually access it, sell it, transfer it.
Pretty much.
Right.
When it's recorded on the distributed ledger and you have the ability to dispose of it, that FMV is income, and again, it becomes your basis in the new coins.
Okay, mining, forks, airdrops. One more common one, gifts. What if someone gifts me crypto? Say, my parents send me some ether. Is that income to me when I get it?
Generally, no. Receiving a bona fide gift, meaning a true gift, not disguised payment, is not considered taxable income to you, the recipient, at the time you receive it.
Okay, that's good. But I assume there are tax implications down the line when I eventually sell it.
Absolutely. This is where it gets quite tricky. The basis calculation for gifted property uses a special dual basis rule. It depends on whether you sell the gift later for a gain or for a loss.
Dual basis. Sounds complicated. How does that work?
Okay, if you eventually sell the gifted crypto for a gain, meaning for more than the donor's original cost, your basis for calculating that gain is the donor's original adjusted basis, potentially increased by any gift tax the donor paid.
So I inherit their potentially low-cost basis.
Essentially, yes, for gain purposes. This prevents appreciation from escaping tax just by gifting. But
There's a but.
But if you sell the gifted crypto for a loss S, your basis for calculating that loss is different. It's the lesser of either the donor's basis or the fair market value of the crypto at the time the gift was made.
Whoa, wait. So if the crypto dropped in value between when the donor bought it and when they gave it to me, my basis for calculating a loss could be that lower FMV at the time of the gift.
Exactly. This rule prevents people from gifting assets with built-in losses just so the recipient can claim a bigger loss deduction.
That seems like a potential trap. You really need to know the donor's basis and the FMV on the gift date.
You absolutely do. And here's the real danger zone. If you can't get documentation for the donor's basis, the IRS position is that your basis is zero.
Zero. So if I sell it, the entire amount I receive could be taxable gain.
Potentially, yes. Documentation for gifted assets is incredibly important.
Yikes. Okay, super important point there. So we figured out acquisition basis when a tax event happens. Now, what about the type of gain or loss? Is it capital or ordinary? Why does that distinction matter so much?
It matters hugely because it determines the tax rate you pay on gains and how much you can deduct in losses. Generally, taxpayers prefer capital gains, especially long-term capital gains.
Long-term meaning you held the asset for.
For more than 1 year, long-term capital gains get preferential tax rates 0%, 15%, or 20%, depending on your overall income, which are usually much lower than ordinary income tax rates. Short-term gains, for assets held 1 year or less, are taxed at your regular, higher ordinary income rate.
Okay, so we want long-term capital gains. What about losses?
For losses, you generally prefer ordinary losses. Why? Because ordinary losses are more flexible. They can typically be deducted against various kinds of ordinary income, like your salary or business income, subject to certain limits. Capital losses, on the other hand, are primarily used to offset capital gains. Deducting them against ordinary income is heavily restricted.
Right. So how do we know if our crypto gains and losses are capital or ordinary? Does it depend on how we trade?
It depends crucially on whether you're classified as a dealer or as a trader-investor. This is a fundamental distinction in tax law.
Okay, what's the difference?
A dealer is someone who buys and sells property, in this case crypto, as part of a business, holding it primarily for sale to customers in the ordinary course of that business. Think of like a car dealership. Their cars are inventory. For dealer, the crypto is inventory, and all gains and losses are ordinary. However, this is relatively rare for most individuals involved in crypto.
So most people trading crypto aren't dealers, even if they trade a lot.
Generally, no. Most individuals are considered traders or investors. They're trading on their own account, seeking profits from market movements, not selling to specific customers. For traders and investors, their crypto assets are typically considered capital assets. This means their gains and losses are capital gains and losses.
Even if someone is a full-time crypto trader making hundreds of trades a day, they're likely still getting capital treatment.
Very likely, yes. There's case law, like Marin v. Commissioner, which basically says even very frequent and substantial trading activity doesn't automatically make you a dealer if you don't have actual customers you're selling to. You're trading against the market.
Okay, so for most listeners, we're probably talking about capital gains and losses. You mentioned capital losses are restricted. How restricted?
Very. You can deduct capital losses against your capital gains without limit. So if you have $10,000 in gains and $12,000 in losses, you can wipe out the gains. But what about the remaining $2,000 loss? If you don't have any more capital gains to offset, you can only deduct a maximum of $3,000 of that excess capital loss against your ordinary income per year. $1,500 if married, filing separately.
Just $3,000 a year against ordinary income? That seems really low, especially given crypto volatility. What happens to the rest of the loss?
It gets carried forward to future tax years. You can use it to offset future capital gains or continue deducting it at that $3,000 annual limit against ordinary income. But yeah, it can take a long time to use up large capital losses.
Wow, okay. That capital loss limitation is harsh. Good to know. Let's talk about tracking specific units. Say I bought Ether multiple times at different prices. When I sell some, can I choose which Ether I'm selling to manage my gains?
Yes, you can, if you meet the requirements for specific identification. This means you need to be able to definitively identify the specific units of crypto you sold.
Yeah.
You'd need documentation showing, for example, the unique digital identifier, address, or transaction hash for the specific units being sold, and be able to substantiate the cost basis and acquisition date for those specific units.
That sounds challenging, especially if you're trading frequently across different platforms.
It can be very difficult, sometimes impossible, depending on how exchanges handle records. So if you cannot specifically identify the units you sold,
And what?
then the IRS default rule applies, FIFO, first in, first out. This means you're deemed to have sold the oldest units of that particular crypto first.
FIFO. And given that crypto often goes up over time, FIFO probably means you're selling the lowest cost basis units first, potentially leading to larger taxable gains.
Often, yes. That's usually the result of FIFO in an appreciating market. So specific identification, if you can manage the record keeping, often gives you more control to potentially minimize short-term gains.
Right. Okay, shifting gears slightly to compliance. How does all this actually get reported to the IRS? What forms do people need to be aware of?
Well, things are changing here. Historically, it's been largely on the taxpayer using forms like Form 8949 and Schedule D. But starting with tax year 2025, there's a new form brokers will use, Form 1099-DA.
1099-DA, what's that for?
U.S.-based brokers think exchanges will be required to use Form 1099-DA to report the gross proceeds from digital asset sales and exchanges directly to both the taxpayer and the IRS, similar to how stockbrokers issue 1099-B forms.
Ah, okay, so the exchanges will be reporting the sales information. Does that mean the taxpayer doesn't have to do anything?
Not quite. While the 1099-DA will report proceeds, you are still ultimately responsible for reporting the transaction correctly on your return, including calculating and substantiating your cost basis. You'll still likely need to use Form 8949, sales, and other dispositions of capital assets to list out the details of each transaction description, dates, proceeds, basis, and gain loss. You use this form to reconcile the info from the 1099-DA and make any necessary adjustments, like rebasis.
And then Form E949 feeds
Into Schedule D, Capital Gains and Losses, which summarizes your overall capital gain or loss situation for the year. So, 1099-DA from the broker, reconciled on your Form 89949, summarized on Schedule D.
Got it. That makes sense. One last area, international. What about someone who isn't a U.S. resident? Say, someone living in Europe who trades crypto on a U.S.-based exchange. Do they owe U.S. tax on their gains?
This is where it gets interesting, especially regarding capital gains. Generally, under Section 864, trading in stock or securities for a non-resident's own account isn't considered a U.S. trade or business, which avoids certain types of U.S. tax. For capital gains specifically, the key rule often involves physical presence. A non-resident alien individual is typically only subject to U.S. tax on their U.S. source net capital gains, usually at a flat 30% withholding rate if they are physically present in the United States for 183 days or more during the tax year.
183 days. So if you're living abroad and trading remotely on a U.S. platform, as long as you don't spend half the year physically inside the U.S., your capital gains from those trades are generally not subject to U.S. tax.
That's often the practical result for capital gains, yes. The physical presence test under Section 871 provides a significant shield for non-resident crypto traders interacting with U.S. markets from abroad. Of course, they still need to consider the tax laws in their own country of residence.
Right, their home country taxes would still apply. But that 183-day rule is a major point for global traders. Okay, this has been incredibly helpful, a real deep dive. Just to recap the big things. Crypto is property. Your basis depends heavily on how you got it, buying, mining, gifts, all have different rules. Your activity level usually determines if gains losses are capital, most common, or ordinary, and capital losses have that strict $3,000 deduction limit against ordinary income.
So what does this all mean? I think the core issue, the tension, is applying these established, often rigid property tax laws designed for tangible things or traditional securities to this new, digital, borderless, highly volatile asset class. It demands really meticulous record keeping, constantly tracking fair market value in USD for almost every interaction. That's frankly a huge challenge for taxpayers, advisors, and the IRS alike.
Definitely something to keep in mind when planning your next transaction. And one final thought to leave you with. We focused entirely on U.S. federal tax law today. But remember, U.S. tax treaties with other countries generally don't bind individual U.S. states. So the moment your crypto transactions cross state lines, or especially international borders, you could be stepping into a whole different layer of complexity. State income taxes might apply based on residency or where activity occurs. Foreign taxes could be triggered. It can create this complex layer cake of tax obligations completely separate from the federal rules we just discussed. Something crucial to consider in this globalized world.